Apple just told millions of customers the same thing a scalper tells you outside a stadium. Prices went up, and it's because the supply chain is broken. MacBooks, iPads, the works. In the same 4-day window where Apple admitted it can't get enough AI memory chips, Micron got cut in half. ARM holdings dropped to double digits. Qualcomm, Marvell, Texas Instruments, Western Digital, all down around 9 to 10%. And Nvidia, the most valuable company on Earth, just shed another 4% in a single session, while the S&P 500 bled 1.4%. But none of that is the real story. The real story is what happened 48 hours later. When the dust settled, Alphabet quietly confirmed its AI chips are now a real alternative to Nvidia. And the information was first to report that OpenAI, the company that started this entire arms race, has been asked by the White House to delay its GPT 5.6 release. CNN, Axios, TechCrunch, and Bloomberg all covered it on June 25th and 26th. And here's the context that makes this heavier than it looks. This follows the administration's export control directive that already forced Anthropic to pull its Mythos and Fable models. According to the same reports, this is the first time the U.S. government has ever preemptively restricted a model release before it launched. If you're still holding the same basket of AI names you bought in January, this video might be the most important 10 minutes of your week. Here's what you're about to learn. First, the exact timeline of the June 2026 tech crash. Not the headline numbers, but the three forces underneath that explain why this happened now and not in March or December. Second, why Apple's price hike is actually the canary in the coal mine for the entire sector. Third, the contrarian signal that tells you whether this is a buying opportunity or a falling knife. And fourth, this is the part you'll want to screenshot, the one word that separates the AI companies that will survive this washout from the ones that won't. This is not financial advice. I'm not your advisor. I'm a guy who reads the filings so you don't have to. Let's go. June 23rd, NBC News runs the headline, "Global Tech Sell-Off Intensifies, Led by AI and Chip Stocks," and they weren't being dramatic. The S&P 500 closed lower by 1.4%, but inside that average was carnage. SanDisk, Micron Technology, and ARM holdings all plunged more than 10%. Marvell, Analog Devices, Western Digital, Texas Instruments, and Qualcomm all fell around 9%. Nvidia, the largest publicly traded company in the world and the focal point of the AI boom, tumbled 4.15%. That doesn't sound like much until you remember we're talking about a $2 trillion company. 4% of $2 trillion is real money leaving real portfolios. Then, June 25th, Apple announces it is raising prices for MacBooks and iPads because of the memory shortage, the same shortage that just crushed Micron and ARM. Apple stock tumbled more than 6% on the news. June 26th, CNN doubles down with a piece titled, "AI Stocks Melt Down Again." The market wasn't just pricing in fear, it was pricing in a physical constraint. But here's where it gets interesting. While retail investors were panic selling their index funds Tuesday morning, one group was quietly placing buy limit orders 3% below the close. I'll tell you exactly who and why in Section 3, but first you need to understand the three forces that caused this. Force 1, the memory wall. Every large language model, every image generator, every voice clone you see on TikTok runs on high bandwidth memory, HBM. There are exactly 3 companies on Earth that make it in the volumes the AI industry needs. And Apple just confirmed what the supply chain already knew: there isn't enough. When Apple raises consumer prices because it can't source components, that isn't a demand problem. It's a physics problem. You can't code your way out of a shortage. You can't prompt engineer more silicon. The memory wall is real, and every AI company just hit it at the same time. Force 2, regulatory pressure. The information broke the story first on June 25th. CNN, Axios, TechCrunch, and Bloomberg all confirmed it by June 26th. OpenAI is staggering its GPT 5.6 release after a White House request. Let that sink in. This isn't just a bureaucratic slowdown. It follows an administration export control directive that already forced Anthropic to pull its Mythos and Fable models. And according to those same reports, this is the first time the US government has ever preemptively blocked a model release before launch. The company that forced Google to panic launch Bard, that forced Microsoft to rebuild its entire product stack around Copilot, is now being told by the US government to slow down. When the growth story depends on exponential scaling and the government says, not so fast, Wall Street's valuation models break. Not because the technology is bad, because the denominator in the growth equation just got capped. Force 3, the ROI reckoning. On June 22nd, Susquehanna cut Accenture's price target from $186 to $140. That's not a trim, that's a 25% amputation. Why? Because after meeting with management, Susquehanna realized the AI consulting boom isn't converting to repeatable revenue the way the models assumed. And it isn't just Accenture. A Reddit post from late May, confirmed by Uber's own earnings commentary, revealed that Uber exhausted its entire annual AI budget in the first 4 months of 2026 and is now questioning whether the spend produced any measurable return. When the companies buying the AI tools start asking if they're actually making money, the companies selling the AI tools have a problem. Now, this is the part most people get wrong. They think the crash is about AI failing. It's not. It's about AI succeeding so well that the physical infrastructure underneath it has broken. So who was placing those buy limit orders while everyone else was selling? The same analyst who just cut Accenture replaced that view with something else, Alphabet. On June 26th, CNBC reported that Alphabet is burnishing what they called one of its best weapons in the battle for AI supremacy, its tensor processing units, or TPUs. For years, TPUs were Google's internal secret. Now they're being positioned as a compelling alternative to Nvidia's market-leading GPUs. Why does this matter when the whole sector is crashing? Because analysts aren't modeling growth based on hype anymore. They're modeling it based on who controls the bottleneck. And the bottleneck isn't the model, it's the chip, it's the memory, it's the data center power, it's the cooling. Alphabet is seeing robust expansion modeled above 50% in 2027. Not because their chatbot is better, but because their infrastructure is vertical. They design the chip, they own the data center, they control the cloud. When you can't get an Nvidia GPU at any price, you rent a Google TPU. That's the contrarian play. Not the front-end AI company with the viral demo. The back-end infrastructure company that the front-end companies can't exist without. The same logic applies to the memory shortage. Yes, Micron got crushed in the sell-off, but Apple just proved that memory is non-negotiable. When supply catches up, and it will, the companies that spent this downturn locking in long-term supply agreements, building fabs, or designing memory-agnostic architectures will be the ones that look like geniuses in hindsight. And if you're wondering whether this is a buying opportunity or a falling knife, the answer lies in one word: infrastructure. Here is the checklist. 1. Does the company own the bottleneck or rent it? If they rent compute, they're exposed to price hikes and shortages. If they own the stack, they control their own destiny. 2. Is their AI revenue tied to actual contracts or pilot programs? Pilots get canceled in downturns, contracts get renegotiated, but they don't vanish. 3. Are they spending more than they're earning on AI, and for how long? Uber's 4-month burnout is the warning shot. The companies that survive this washout will be the ones with unit economics. The Guardian's contrarian take on June 27th was titled, "The AI Bubble Has Further to Run Despite the Looming Crash." They might be right, in select names. But the bubble has already popped for companies that were selling shovels without owning the gold mine. The question is whether you can tell the difference. If you want to see a deeper breakdown of the 3 infrastructure names I'm tracking through this sell-off, and why one of them just got a 50% plus growth estimate from analysts, subscribe and comment infrastructure below. I'll drop that breakdown in the community tab within 48 hours. And fair warning, every video on this channel is built entirely with AI tools, research, voice editing, analytics. If you want to see the exact workflow I use to produce faceless finance content in under 3 hours, the link is in the description. It's not an ebook, it's the actual setup. Tuesday at 2 p.m., we're covering the analyst who just flipped from bearish to bullish on AI and the 2 hidden data points that made him change his mind. If you don't want to miss it, hit subscribe and the bell. Because in this market, the people who read the fine print are the ones who keep their money.